This video is going to be about FEMA, Foreign Exchange Management Act 1999. But before we get started, I want to clarify a few things related to self-study. In my previous video of Understand Why about RERA, I mentioned a lot of things, and you have to understand that when you take a class, you're not only listening to the person but also are reading and writing something. And after 60 days of your class, you find it difficult to recall things. So when that happens in a class, that means it happens more in a self-study session. So you have to understand that reading something once is not enough. You have to give it a twice reading. You have to give two readings to it. Then only your self-study will actually be effective and you will feel more confident. You would have understood more in your second reading. So anything that you're watching and you're trying to do a self-study, you're doing a great effort. Just do it twice. Whenever you're free, give it a second reading. Go through it. You don't have to memorize things, but you have to go through things so that you get used to it. You understand concepts better in the second time. So to start with Foreign Exchange Management Act 1999, a little debrief about its history. FERA. FERA is where foreign exchange started. It was a Foreign Exchange Regulation Act 1973. If you understand that the names are two different names and the acts are two different acts for a reason. So far you have seen Income Tax Act a lot and you see that it's going on since 1961 without any new act coming in. There were more income tax acts before 1961, but 1961 has not changed. So reason why a government replaces the act is important for you to understand. Number one, it is if it is consolidating the act into one single act, like there are 5-6 acts which are giving directions and there is an ambiguity in application of the law, then the government will consolidate it into one act. For example, IBC. The biggest and the latest example is IBC and also GST, because GST also consolidates a lot of taxes. That is one thing. And the other reason is that when the entire core principle of an act changes, why there is an act, the entire core principle has changed. So that is the case in FEMA. What has happened is Foreign Exchange Regulation Act was looking towards conserving foreign exchange, and Foreign Exchange Management Act treats foreign exchange as an asset. So there is a huge difference on how the government is approaching foreign exchange. After 1991 trade liberalization all over the world, that global openings, the Foreign Exchange Regulation Act was really tedious to manage. The trade was not happening fluently. So that is the reason why this problem was identified in 1998. FEMA was proposed and it was passed in 1999. So you have to understand that the approach of the government has changed. So this is one of those things, one of the differences that you have to understand. One more big difference is that Foreign Exchange Regulation Act used to have criminal offences and Foreign Exchange Management has civil offences. And the difference between criminal and civil is that normally criminal offences will involve imprisonment and civil offences normally involve fines, where you are given a fine and in some cases you get the imprisonment in a serious contravention. So this is one thing, and with FEMA, government has understood that it is not a one-time thing. It is with time foreign exchange transactions are going to increase. So earlier when you had a problem, you had to approach High Court under FERA, but in FEMA you have Special Director Appeals and you have Special Tribunal, and then you move to High Court. So there are two more administration parts and jurisdiction parts where you can clear your problems. So that being said, let's move to what is FEMA. Foreign Exchange Management Act 1999 is going to be a difficult part of your subject. But at the same time, it's a language. If you understand a few words, you will be able to speak fluently. So to start with, we'll go with the definitions of this act. There are certain definitions that are very, very important that will keep coming throughout the act, and you will be able to fluently translate things once you know these definitions. For example, current account transactions and capital account transactions. Before we get into definitions, I will also tell you about the parts of this act. So you might know how an act comes into the picture, how a bill becomes an act, but you have to understand that rules and regulations are there in FEMA. So rules are given by central government and regulations are given by RBI. So there is central government, there is RBI. Then who's there? There's authorized persons. With FERA, there was a need of delegation. Not everything can be seen by the government or the RBI. So a authorized person, AD or AP, authorized person is nothing but our banks, our foreign currency exchange agencies. So these are authorized persons under the Act. There are two more people, that is you and me, residents and non-residents. In the Act, they are not called residents and non-residents. They are called person resident in India, person resident outside India. Again, these are also definitions that you have to analyze critically to have a hand on the Act. So to get into the definitions, we'll start with capital account transactions definition. It is one of the most easiest and the most beautiful definitions you'll ever hear. Okay, I'll just give it to you in a layman language and you'll appreciate how important this is. Capital account transaction. So any transaction which creates an asset or liability, or including contingent liability for a resident in India, or which creates an asset or a liability for a non-resident outside India. So it's not just this, I'll add on to this definition further. So any person who is resident in India, a transaction which creates assets, liabilities, including contingent liabilities outside India. And for the person resident outside India, which creates only assets and liabilities, not contingent liabilities in India. If you see and if you notice very carefully, there's prudence even in this particular definition. There's contingent liabilities of Indians that has been recognized as a capital account transactions, but a person who's resident outside India, his capital contingent liabilities is not recognized as a capital account transaction. So this is one of the beautiful definitions because of the hidden prudence in the concept and how easy it is. So it's just assets and liabilities. Moving on to current account definitions. Current account transactions, you like it even more because it is everything other than capital account transactions. In the definition, you will have 4 inclusions which you can read on your own. Moving ahead, you have person resident in India, which is the most tricky definition there is according to me in FEMA. So a person resident in India is a person who resides in India for more than 182 days. More than 182 days, and there are 2 exceptions to these people. So if you're not residing in India for more than 182 days, you do not check exceptions. But if you're residing for more than 182 days, you will check these 2 exceptions. One is a person who goes outside India for 3 reasons and a person who comes inside India for other than the same 3 reasons. So the 3 reasons are employment outside India or employment in India, business or vocation, or for any purpose with an intention to stay in India for an uncertain period. Any purpose with an intention to stay in India or outside India for an uncertain period. So these are the 3 reasons. You have to read these definitions on your own to appreciate the depth a person has put into the definitions. So still section 2 you have definitions, and we will move forward to section 3. You have to understand that it's still a management act, but not all transactions are allowed. So how do you allow transactions? You cannot sit down and write what transactions are allowed. So for you to understand what transactions are allowed, the government will first say that foreign exchange transactions are not allowed. And then they'll bring in the exceptions that they actually allow. For example, for section 3 speaks about foreign exchange transaction. No individual should get into a foreign exchange transaction. No person should get into a foreign exchange transaction. But the exception is except where permitted in the Act or with the permission of RBI. So these are the things, like these are the beautiful points that you have to understand and appreciate in the Act. Then you move on to section 4 and section 5 and section 6. Section 5 and 6 are the most important sections for you. Section 5 is current account transactions and section 6 is capital account transactions. In short, section 5 is where the government is a little liberal because it's in the course of ordinary business. And current account transactions, there are 3 schedules. They will define you the current account transactions, they will tell you the general transactions in that definition, and there are 3 schedules which are there. So schedule 1 is all about prohibited transactions. You go with the logic and understand why certain transactions are prohibited. For example, you cannot win a lottery in India and take the proceeds outside India. You cannot do horse racing or gambling in India and take the proceeds outside India because it disturbs the balance of foreign exchange, the foreign reserves of the country. Second schedule is transactions which are to be allowed by the central government, which on special permission of central government will take place. But these are mainly for PSUs. a PSU making an advertisement or a cultural trip. And Schedule 3 is about transactions that are allowed by RBI. This is where RBI takes control. These are transactions for you and me, for example, going on a foreign trip or going for education outside India, for a medical treatment outside India. So these are the things that are mentioned in Schedule 3, which you will have to read. Schedule 3 has a liberalized system of payments. This is what they call it. And they allow up to 250,000 US dollars in 1 year. Over and above $250,000, you will have to go to RBI for a specific permission, saying why you need to pay more than $250,000. In reality, how this mechanism is working is that you approach your banker and you tell them that you're making a trip outside India. They are the authorized dealers. So they will manage all your transactions up to $250,000 for you, and they will verify all your applications, and they will see that the purpose is genuine, and you will get your foreign currency. And this is the practical part that you will not understand directly in the act. One or two readings, you will understand things. Moving on, there's another thing which comes under this current account transactions, that is import of goods and services. So it's not a section, it is a regulation outside the section. Once you read this import of goods and services, you will understand a lot of things. Import of goods and services, your authorized dealer, which is your banker, there's a lot of procedure of imports also, you will know, bill of lading, all those things. So your authorized dealer will verify all your applications, whether you have actually imported goods in India or any service in India, based on which he will authorize the transactions. You will have to make payments for any imports you make within 6 months. And in case you need an extension, you will have to apply to RBI through an authorized dealer for an extension of another 6 months. So there's one more it's a minute detail you will appreciate once you understand. It says that if you made an import of goods or services, and because of any financial difficulty or any dispute between the parties, the payment may be delayed. But the payment which is delayed, it bears an interest. A person cannot pay that interest for over 3 years of period. Why? Because a person might call a loan transaction as a current account import transaction, take goods, overvalue the goods. Let's say you purchase goods of $1,000 at $2 lakh, you overvalue the goods, it becomes a form of your loan. You cite a practical problem saying that there is a financial dispute between us and the party, and then you keep the money and you keep paying interest. So they don't want you to mask any transaction which is capital account transaction in the name of current account transaction. So it clearly says that we will not allow you to pay any interest for more than 3 years, whatever it is. So these are small details which you will appreciate once you understand why the government would have done that thing, why the lawmaker has written something like that. Moving on, next, you will have capital account transactions, and this is a little easier when compared to current account transactions from exam point of view, because current account transaction has 3 schedules and you have to memorize these schedules so that when they ask a question in the exam, you can clearly distinguish between a transaction which is allowed under Schedule 1 or not allowed under Schedule 1, which requires permission of central government or RBI. Moving on to capital account transactions, it does not say much in the sections, but there are regulations on purchase of immovable property in India or outside India. So these kind of regulations, once you read, you will easily understand. There's no problem in it. By now, if you complete the capital account transactions, you will reach up to 40 to 50% of entire FEMA syllabus for CA final. There is one more category in capital account transactions. There are certain transactions which are completely prohibited. This is a very famous exam question, and it keeps coming either in MCQs or in a descriptive question, where a person resident outside India cannot invest in certain activities such as chit funds, such as plantation and agricultural activities, real estates, etc. There are 5 categories you can read on your own. There are transferable development rights, that is joint development rights which are transferable, something like that. And moving on, the next very latest amendment is external commercial borrowings. This is by far the most detailed regulation that is available for borrowings that you can take in India. I'll just sum it up for you in very, very simple language. You will have to read in detail to understand what it is. Why ECB has come into picture is that The government does not want you to take loans which are unstructured, which have unfavorable terms and conditions. So basically what ECB is doing, that it's putting an upper cap. So if you say that what is the cost of interest or finance cost that the company is bearing, is that it has to be within 450 BPS, more than LIBOR or MIBOR. So that 450 BPS is nothing but 450 basis points, that is 4.5% of interest additionally to what is the current prevailing rate. So you cannot pay an X amount of interest, let's say 25% interest. These are things that happen, like where a subsidiary pays a holding company which is outside India 25% interest on the amount it is investing. So these are the things which are being regulated. More terms and conditions are there. There's rupee denominated external commercial borrowing, and there is foreign currency denominated borrowings. So naturally, when it is a rupee denominated borrowings, you must have learnt in your SFM that the exposure is not to the person who is in India, the exposure is to the lender. So naturally there is less restriction in this category than the foreign currency denominated borrowings. And moving on, ECBs, you will have certain categories. You will have minimum average maturity period for a particular type of loan. What is the maturity period you can have? Such things, so on and so forth. There is automatic route and there is approval route. This is what comes practically. In real life, automatic route is where you do not have to seek RBI's permission. Loans up to 750 million is allowed, and you do not have to go to RBI. You can just directly go through an authorized dealer and get the loan cleared. But if you have more than 750 million US dollars, then you will have to go to RBI through an AD. So external commercial, once you complete external commercial borrowings, you'll be done up to 60 to 65% of FEMA. Then you will have to go through things again, because so far the subject is heavy, although it's easy to understand. And moving on, next you will have section 7, 8, 9 and 10. They are quite simple and they are very, very practical. Section 7 is about export of goods and services. And I'm sorry, I have made my notes to make it simpler for you, so I have to keep referring to these things, because even after 3 or 4 studies, it's not easy to remember things. So you have to understand that when you do a self-study, you need a lot more to remember things. You will have to keep doing continuous revisions. So as section 7 goes, it's export of goods and services. The most easy thing as a transaction is always export in India. So when you read export of goods and services, that will still be easier than import of goods and services. You will see that the general guideline is that you have to get the funds, you have to repatriate the export proceeds within 9 months. And if you are selling through a warehouse, then it will be 15 months. Earlier, when I was writing my exam, it was 6 months and 9 months. So I think RBI has relaxed this duration. And you will read about form, Softex and EDF. It will tell you the general procedure, how you apply, how if you have received an advance for an export, then you have to commit and you have to supply the goods within 1 year, or else you have to go approach RBI that why you have not supplied the goods within 1 year of time from the advance you have received. Going on, section 8 will be realization and repatriation. You have to understand realization and repatriation are two different things. Again, repatriation is something you will have to refer in definitions. And realization is something, realization is receiving a foreign exchange. Repatriation is bringing it to India and converting it. That is surrendering your foreign exchange and taking rupees instead. In practical life, when you see, when you go on audits, you will see that not every transaction is realized and repatriated individually. The company maintains a foreign currency account where they receive all the foreign currency and they make all the foreign currency payments. On a monthly basis or on a fortnightly basis, this account is settled and you repatriate the funds or you make the payments, whichever is due. So this is what happens practically. Section 9 is exemptions from realization and repatriation, which is in case you are a traveler, if you've got some US dollars, whether or not you can retain it. So this is something which will be very interesting. You just have to imagine that you're going on a foreign trip. And section 10 is authorized dealers, authorized persons. This section, you will understand what are the kind of restrictions that are imposed by RBI for a person to become an authorized person. Up to section 10, you will all have about the acts which is more relevant towards you. Moving on to section 12, 13 and 14, these are sections that are more about administration. So section 12 will be about the powers of RBI to regulate or inspect the authorized person. and so on. You will have adjudication, you will have compounding of offences, you will have appeals. So if you read till section 10, almost 80 to 85% of your FEMA from CA finals point of view will be completed. And when it comes to exams also, this is where you will get most of your questions from. Some of the questions come from penalty side, but I think this is something you'll understand, and you have to give 2 or 3 readings to be comfortable and confident in the chapter. So there were a few hiccups in the video, and if you watched so far, just leave a thumbs up, and it'll get better with time because I'm not used to doing it on a video. All the best. Thank you.